Hello, everyone, and welcome back to Sudden Wealth. I hope you guys are having a wonderful weekend and you've recovered some good strength for the upcoming week. If you do enjoy the content, please consider dropping that like and subscribe. It greatly helps the channel, so thank you very much for your support. As I've mentioned, next week I'll be traveling for business, Monday through Thursday, which means I'll be recording in a bit of a different setup. So I hope you guys can bear with me and enjoy the content in any case. Now, today I wanted to discuss something which has been thrown around quite often as of late, which is the liquidity cycle. What is it, what it means, and do we actually still have it in the traditional sense of the word, like it used to be? What it is, maybe try to make it as simple as possible. The liquidity cycle is nothing more than contraction and expansion of credit and money in the economy and the cost of money as well. So basically, you should imagine, in the old economy, meaning pre 2008, you would have periods of, low interest rates and uh, and quite some liquidity in the market. So the access to borrowing was very easy. So credit was expanding quite quickly, and the economy would grow from that. Then you would have periods where you had too much borrowed money and the interest rates would need to go higher and higher until it would encourage saving, which would obviously reduce consumption, and the economy would shrink. So that was and usually you had a bit of more difficult times in the economy, and you would basically you would even have a recession. And then once you had too many savings in the system, interest rates started to go lower, which would discourage saving and would encourage borrowing, and you would repeat it. Now, what has happened since 2008 is you no longer have the liquidity cycle in the sense of the word. You have you have liquidity high, so high liquidity, and higher liquidity. That's it. It's a little bit like, if you think about the economy in the US, in the past you used to have surplus and deficits. Nowadays you have deficits in good times and you have higher deficits in bad times. It's the same thing. And the best asset that correlates post 2008 with this is crypto. So when you have the highest liquidity, which tends to happen every 3.5 years, you have the highest performance of crypto, and then you have basically the big bull euphoria part of the cycle. But this is valid for the other risk assets as well, not just crypto. But just crypto goes up higher more for a very simple reason. It's a much smaller market, which means any liquidity that comes in makes a lot of difference. When people say liquidity means money creation, means to all purposes digits on the screen, okay? And because it's it's a little bit common sense. What do you think it's easier to move, a small pebble or a huge rock? What do you think it's easier to move, 300 trillion or half a trillion, right? So that's why you expand it and contract it the most. And you actually don't really contract it. You basically you have less liquidity than before, and so what ends up happening is that the lower liquidity leads to higher retracements. Also, because when liquidity comes into crypto, it punches everything higher very aggressively. But also, when you remove some of it, you also pull it down quite aggressively as well. Now, the thing that has been done here is, since we are in the debt system, that means we no longer have real money. That means that we need more and more debt all the time, because debt actually works as money. And when you have QE, you have essentially monetization of debt, meaning the Fed creates money and buys the bonds of the government in order to finance all the deficits that they have. And what happened in the past, since basically crypto was invented, is that we are always in this weird situation where, we engage with QE for a period of time. But because of how the system is designed, you have to have QE1, QE2, QE3, QE4, and then QE infinity, and it will grow bigger and bigger and bigger each time, because if you don't do it, you have a massive, massive recession, depression style. And even in this time period, when you had, interest rates going higher, people said, oh, but now the Fed is being restrictive, right? Because it's basically increasing interest rates. So, no more easiness of borrowing, blah, blah, blah. Now, that's partially true. Is 5% interest rates more restrictive than 0%? Obviously. Why did stocks, and why did I predict that stocks were going to make new all-time highs and crypto was going to make new all-time highs, etc.? Because the government deficits were expanding the money supply in any case, which means you had the Fed being more restrictive on this side, but the Treasury being more expansionist of credit than the Fed was being restrictive. So money supply was still going up, and that money needs to go somewhere. So it goes to risk assets. Now, what is going to happen, in my view, is if rates come down, which are expected to come, and they will need to come down, otherwise the debt problem of the US will run rampant out of control. Why? Because with this level of interest rates, by 2028, you're paying 2/3 of your tax revenue are going just to pay interest on the debt. And the Fed knows it, so they won't allow it. So they will find an excuse to lower rates. I don't know what's the excuse going to be. Can be the job market, can be the slowing down of the economy, can be fighting for freedom somewhere on the globe, right? You know how these Operation Freedoms, maybe they will come up and say, oh yeah, look, maybe with 3%, maybe 3% inflation is what we need. Whatever the case may be. Now, the question you ask me is, okay, but how can we leave this cycle that we entered in 2008? There is only one way, is that the growth of the economy outpaces the growth of debt so much that it allows for all this spending by the government. And because the exponential growth is so high that the tax revenue collected from it, despite the government spending all that money, you eventually turn the budget into a surplus and you can start reducing the debt. My view, I think the hope is with AI that our productivity will explode to such a degree that basically that's how you get out of this debt problem. Otherwise, you end up like Japan, which is 30 years, no growth, no inflation, more adult diapers sold than baby diapers, no kids, declining population, country stuck in the 80s, 40 years for a new all-time high. The stock market is a bit different because the US always attracts foreign investment, unlike Japan. But you get to a point where it's very hard to keep moving forward. So that's the price you pay. So you don't have a collapse of the economy. You don't have a 1930 style of depression, but you do pay a price, which is asset prices go up so much and productivity is so null that you end up not being able, to even have kids anymore at some point. So that's the price you pay. Now, when it comes to crypto has an advantage. I already explained one of them, which is it's a much smaller market, so it's easier to move. But it has a second advantage, which is it has, the real crypto at least, it has well-defined rules from the start. Even Bitcoin, which inflates, by the way, sorry to break the bubble, but they call Bitcoin deflationary. Really? So how do you go from 0 coins to almost 20 million coins? By inflating. Now you say, oh, but it's inflating less. Okay, but it's still inflation, right? It's like saying, oh, inflation was 5% and now it's 2%, so we have deflation. No, you still have 2% inflation. It's just lower than 5, but it's still inflation, right? But going back, to the meat and the bone, which is crypto has well-defined rules. See, the problem with stocks is very simple. Let's go first with the problem of commodities. If commodity prices go up too much, there's an incentive to mine. Let's imagine it's gold, to mine as much gold as possible. There's an incentive to drill as much oil as possible. To increase the supply as the price going up, there's a big incentive to drill, or to mine, which increases the supply, and eventually the demand peaks, but the supply keeps on increasing and it pushes the prices down. When it comes to stocks, what happens? If a share is doing very well, if a stock is performing very well, what's the incentive? First, you have overhead costs in a company, and you don't have it in real crypto because you don't have a company. There's no Bitcoin company, so there's no. The only overhead cost you have with Bitcoin is the negative externalities of mining, because you need to pay the mining hardware company, you need to pay for the electricity. But if you take, for the example of Ethereum, for example, is much cheap, much less overhead cost. Number two is when your share price, if you're running a company and your share price goes to the moon, your incentive, I would say even your responsibility to your shareholders, is to do what? Issue more shares, increase the supply of the thing that is going up. While with real crypto, it doesn't matter who's in power, right wing, left wing, center, extremes, recession, depression, economic boom. The rules are the rules. That's it. Trust math, not man. That's the point. And what we're about to enter now is to the hyper phase of the liquidity cycle, which means is when you have the most liquidity into the system combined with the lower or less restrictive policies, which, as you've seen in the past, has improved the conditions, has led to massive crypto bull markets. And the reason why they need to do it, it's very simple. As long as they need to accumulate debt, they need to lower interest rates, and they need to keep on expanding the debt. Why? Because they have trade deficits, they have budget deficits, which means they need to increase the money supply, but they need to pay low interest on that debt. Otherwise, they bankrupt the country paying interest on the debt. Not even the principal, just interest, which obviously they're not going to do. So the solution is going to be, and this is why I predicted this, by the end of the decade, you should see negative interest rates in the US. Does this have negative consequences? Of course it has. I've already mentioned the example of Japan. Does that mean that the politicians, but you see, the issue is you have a big group of politicians who think we can just do this and there's no consequences. There's another group of politicians which says, look, I know that this is wrong and there are consequences, but as long as the consequences happen after I leave or after I'm already very wealthy, that's fine. Maybe it will fall on other person's lap, not mine. And then you have a few small number of people who actually understand the issues, actually concerned about it, but they just hope that growth and technology will get us out. In any case, guys, I think it's now obvious why we have this liquidity cycle, and these tend to happen every 3.5 to 4 years, which matches obviously the crypto cycle. And with that, guys, I think it's clear. If you guys didn't understand anything on my side, or if I forgot to cover something, just let me know. Thank you very much for your support, guys, and I'll catch you in the next one. And don't forget, like and subscribe. Thank you.